CEO of JP Morgan, Jamie Dimon, mentioning that in the next year there might be 6 or 7 interest rate hikes, and that is doubling down from his 3 to 4 prognosis that he had up until recently. And so obviously with seeing inflation, he's seeing, that the interest rates have to be raised even more in the year. Okay, so that's pretty important. Now he does hedge and mention these are just possibilities, not necessarily probabilities. So maybe he's just laying the groundwork for 6 or 7 so that when it turns out to only be 3 or 4, everyone's not too upset one way or the other. People aren't too upset because, yes, interest rates are being raised, and so they're fighting inflation, but they're not overly upset because, hey, instead of 6 or 7, it's only 3 or 4. Is that what's happening here? I don't know. But nevertheless, he's definitely laying down some groundwork and covering himself a little bit. And it's not all bad reasons for the interest rate. Some of it is because of the faster than expected labor market recovery. So that's a pretty positive reason to raise interest rates. They've been down for so long, and the market's recovering. Well, we can raise interest rates, slow things down a bit. So that's a positive reason. Nevertheless, if all of these interest rate hikes are 25 basis points, could be up to 2% by the end of the year. And I guess the real problem is that's not necessarily a lot, but it's a lot in a short period of time. And so how does the market react to this huge increase a small increase maybe, but in such a short time? That's going to be the real question as far as I can tell. Now, the billionaire investor Bill Ackman mentions that he thinks that they should kick it off in March with a 50 basis points increase. So really crack the whip, show the Fed, show their hand that they're really tackling inflation strong. Now, what I'm seeing from this is 2 different, professional investors, part of the professional class, kind of looking at inflation and getting really scared, saying, not only do we have to stop quantitative easing, right? That's obvious. Jerome Powell mentioned that. They're going to try and have that done. And probably that's why everyone's picking March, because March will be when they stop buying more bonds. And by the way, this is all entertainment purposes only, of course. Please consult your own financial advisors. But once March hits, they won't be quantitative easing anymore, presumably. And Jerome Powell said once they do that, then they can start thinking about raising interest rates. Well, everyone's thinking that the first thing that they're going to do is raise interest rates right away. I actually personally think it might make sense for them to just let things simmer so people aren't expecting interest rate hikes. Now, if inflation is still running rampant, they're going to have no choice. They probably will have to raise interest rates. If it's not running rampant, I could see them just letting things simmer and saying, yeah, we want to, but we don't feel like we have to right away. Something like that, some weird wishy-washy kind of statement. And the reason why I think that would be useful for them is that they can kind of slow down the turmoil, let things, as they're ending quantitative easing, make sure things are kind of humming along. And not that they're going to scare markets by raising interest rates all of a sudden. Could just be my personal take, but nevertheless, I as of now, I would still assume, just like everyone here is in terms of, let's say 80% of the market is thinking that there'll be a 25 basis points in that March meeting. So most people are expecting it, and maybe they'll take advantage and do it if everyone's expecting it. It's always hard to tell with these things. But there is a small 20% margin there where people think nothing will change in March. And personally, I'm kind of leaning that way. But like I said, it's going to really depend on inflation numbers going on in that time period. So for example, let's say inflation comes down a bit, right? Why? Because supply chain gets solved a little bit. Is that the only reason for inflation? No, but it's definitely a part of it, right? There's a lot of cost to companies because of shipping. If that comes down, they don't have to pass on all the inflation or as much inflation to the customer. That would be amazing. And that would allow the Federal Reserve to slow things down, take a breath, raise interest rates. Yes, of course, maybe slowly. Like last time with quantitative easing ending down, they took a breath. They didn't do things all of a sudden and ramp things up really fast in a year. So there's definitely the option of things slowing down. I'm not sure what's going to happen. We're just going to have to wait and see, obviously. But this is kind of where things seem to be going right now. The problem, of course, is that they might kill inflation, but they also might kill off the economy, right? You don't want them to take off inflation too quickly or too slowly. It's tricky. And you got to expect and do what the market wants as well, right? You don't want to make them feel too uneasy either. Now, I did see this article, which I thought was interesting. They mentioned that people are looking past the Omicron variant, looking to reopening and a rebound in activity. And so oil prices are going well. And in fact, there's going to be less of an impact on energy consumption than previously expected, I guess, with the virus. Okay, so with this kind of outlook in mind, right, this is a pretty interesting time right now, and it might actually allow the Federal Reserve to move quicker. And this would be them raising interest rates quickly, maybe even 50 basis points, whatever that might be. Why? Well, imagine if everyone really felt like the virus, like this whole plague, it was totally over. Everyone would be excited. I think more people would invest. People would be, excited where companies and businesses are growing. Everything's going back to normal. And that might allow the Federal Reserve to raise interest rates, be really aggressive, because there's all of this positive attitude going on, right? So it's kind of happening, this inflection point in terms of Federal Reserve monetary policy is kind of falling in line with all of the medical things maybe moving in a very positive direction. Now, obviously, a month is a long time from now, maybe 2 months. It's a long time from now, so things could easily change. But, when you look at all these things, it looks like the Federal Reserve is going to have to pull back, really going to have to undo some of the financial policy decisions they've been making. They might have to act too aggressively. That's what I'm kind of nervous about. Might spook the market. However, this might be the perfect time for the ability to be able to spook the market and still not cause too much trouble just because of so much optimism from the fact that everything is going back to normal. That would be really exciting. So this is kind of my perspective. Let me know what you think is happening. Do you think they're really going to be this aggressive? I mean, the tapering is quite aggressive. You can see what they're doing right now. And I actually thought that they might do some tricks in terms of moving, different types of their securities around so it seemed less intense when they pulled out of the bond market. That was my kind of perspective. That's not what they're doing. I thought they might be a little more tricky. You can watch the video on the tapering that we did before. So far, so good. And they're being aggressive, and yet the market's still doing pretty well. Okay, so we're going to have to see what exactly happens with the 10-year. We're going to have to see what exactly is going to happen with the interest rates. I don't know what you guys think is going to happen. Is the market going to collapse when the Federal Reserve starts raising interest rates aggressively to the point that people want to take their money out of the market and just put it in some bonds? And yes, maybe they won't beat inflation, but they'll grow their money some amount. And at the same time as growing their money some amount, they'll for sure not lose it, unlike what might happen in the stock market, right? So stock market, of course, you can make better gains than inflation. Of course, you could lose as well. Whereas with bonds, it's not necessarily so true if you get a safe bond, except, of course, if you're going to lose compared to inflation. So you let me know what you think. Thanks so much for watching. I really appreciate it. Trying to get some of these easier videos out. If I can't, do a 10K and a deep financial analysis and, do the video and putting all the slides together and everything to present it, takes a long time. By the way, let me know any ticker symbols you'd like me to look at. Thanks again for watching. Bye.